where icebergs help is, are they going to follow through? And they're helpful if they don't. So what do you need when you get an iceberg? In this case, green is buy side iceberg. And he's looking to do 75 at a time, and he's done 1,600. We don't know how many he has left, but we know how many he's done and how many he's showing. Now, price is going to treat this, the market's going to treat this price uniquely. In order for an iceberg who's on the buy side, once it's hit, for it to follow through to the downside, you need to stick and get too many longs leaning on them. You need too many longs leaning on a big buy order, whether it's an iceberg or any other order. When you get too many longs leaning on it, that's your high probability that once it's filled, the chase is on and price gets weak. Why is that? Because as you know, longs are sellers, right? Too many longs, too many sellers. And if they're getting long to lean on a big buy order, because remember, you need a buy order to sell to, and you have to sell to cover your long. So they're leaning on this order. And if too many longs come in, gives you the probability that once that order gets filled, bam, the chase is on, because they lean on it to sell to it and they miss it. And too many longs, there are going to be a handful that miss selling it once it's gone. Now, if you don't get too many longs and you actually get too many shorts playing for the breakout, for the continuation, that's when it's a head fake. They fill the order and then they cross right back through it. And that's good information for transition from, in this case, bearish to bullish, even if it's temporary. So when I play this, I want you to watch our 2-minute OPP, which stands for other people's positions. Okay, right? And a sample size of where people are short and where people are long and when. And it gets a little balanced in here. And you could see the shorts in there. It's getting balanced in here, but watch it as it trades through it and right before it trades through it. We don't know when it's going to trade through it, but we do know that he's done 1950 and it's not long when it goes through it. It's actually gets short. See these shorts in here? And the laser goes back to essentially even. Now he's done 2001. All right. You're getting closer and closer. He could not have more than 3,000 because the CME doesn't allow orders more than 3,000. And what we see here is right before it goes through it, it's red here. It stays red. Too many shorts, and it gets red underneath it once it goes through. And too many shorts means if you're short, there's too much competition. There. See how it goes red right there? Boom. Let me stop it. The laser goes red right underneath it. So it wasn't that green with too many longs leaning on it. You've seen a bunch of shorts trying to play the breakout right above it. And then it gets through it, goes short, and crosses back over. And that's the, hey, you got to be careful if you're short. And if you use this as transition and you're bullish anyways, a trigger to get long. And you just look at all these shorts laying in here. And they're all looking up saying, well, what happened? What? No follow through? And the market rallies to our levels of the red and green PWAPs up here. And this is the red one. Holds his great resistance once, holds again twice right in here, holds again right there. I'm saying coming in and coming back down. And then we get ourselves a transitional moment, long bar up, long bar down, sideways to lower. And then we just come in here, we find another one. And this other one is once he pulls it, we go through it. He's showing 500. Here's let's go over this. This is a cool one. We don't see this a lot. First, he comes in as just a 500 lot bid, showing the whole order. Got it? Right here at 40 even. Once he starts to get filled and he does more than 500, but the order ID remains the same, Dave's able to flag it as an iceberg. It's like, wait a second, you're only showing 500 and yet you did 503 and you're still there. Now you're an iceberg, and watch him go green once that right there. So the resting bid turned in or was really an iceberg. He was just revealing 500, which is a huge reveal. And so he didn't turn into an iceberg. He was an iceberg. But when we're able to flag him as one was after he did more than 500. So then he pulls it right there. You see the asterisk. He pulled it, didn't get filled. And that's important because generally price will then go down when he pulls it. Then he comes in with a buy market order that turns in an iceberg, probably to fill the rest. And the market has trouble going straight down because it turns red, turns green, turns red. That became a pivotal spot and a pivotal moment to be careful both ways. That's what we were talking about at this moment, right? I said it'd be hard to be short or long in here, and their fight was on. All right, so where does it go up to and break back down? The PWAPs, not close enough to say that they were great there, I'll admit, but it goes green, goes down, and we come off pretty decently. And then something interesting happened, and that is the market gets too short in here, and we bounce. Now, there was another moment earlier where a bunch of shorts came in after the break, and Dave mentioned it. I seen it. And it was, you guys remember that? It was the be careful being short because of it moment. Right here. All these shorts. It took a while to pop. Oh, this was the example I gave, but right before this, we went from really green on the laser, right, to boom, flip red. You see it here on the vertical right there. And so this is, yeah, if you're bullish enough to get long, that's a trigger to get long. If you're short, yeah, that's even more a reason to get the hell out and cover a short. Because too many shorts, too many buyers, it's hard to go down. And then we go sideways, and then we go into that example of this big iceberg that did a little head fake down to go up because there's too many shorts. And that's how you use icebergs. And that's how you start to piece together how to read order flow instead of just some general understanding of what is order flow. And, you know, it has to be understood and used as the intent of the order and then the market's price reaction to it. It's the dance between the order and the price. It's the dance between the order and the price and other people's positions. Everything is about where the market can be stuck. If it's too short, man, it's just a crowded trade. If it's too long, it's just a crowded trade. And so in trying to worry too much about what you think, you have to think about what does the market think?